Hello everyone and welcome into the channel. My name is Brent and in today's video we are going to be taking a look at the M1 Finance dividend portfolio and doing a recap from the 12th to the 16th of September 2022. We're going to go ahead and hit on 4 different areas today. We're going to go ahead and take a look at number 1, the overall performance of the portfolio. How has it been performing in comparison to the indexes and such over the last few bits. We're going to take a look at our 3 best performers, 3 worst performers. Then we're going to jump into number 2, taking a look at the weekly performance. Now this past week was pretty brutal out there in the market, losing anywhere from 3 to I think 5% in a lot of the indexes and such. So if your portfolio out there lost anywhere either around there or less, you came pretty in line with the market. Number 3, we're going to go ahead and take a look at the activity. We did make some stock market buys last week. We went ahead and queued up some purchases. So we're going to go ahead and cover what positions we purchased. And then number 4, we're going to go ahead and go over into our dividend portfolio income tracker and kind of showcase where the current income is at the moment, and also update it with last week's purchases, kind of updating to the latest and greatest as far as dividend income goes. So that is what we're going to be hitting. I always like to do these on a weekly basis just to kind of showcase, like, hey, regardless of what the market does, we're going to go up, we're going to go down, we're going to trend sideways. We're just kind of showcasing what a normal portfolio does in times on a weekly basis. That way, hey, if somebody wants to go back 3 years ago, that information is here, where we were at with our portfolio, what we were buying. There's always going to be something out there in the market that is, really, really good or really, really bad. So regardless of what it's really going on in the market, we're just going to stay invested. So remember to subscribe, hit the bell, select all notifications, and give this video a thumbs up if you guys are watching this. I would really appreciate it. Okay, so jumping over into the M1 Finance portfolio, taking a look at number 1, we're going to start with the investing tab and taking a look at the overall performance of the portfolio. Now, we have been pulling back week after week here. We have been slightly pulling back here. Our overall return remains positive of 44.71%. We can see that our market gains have dramatically declined from at a peak. At a peak, I believe we had been up anywhere from $6,000 to $8,000 of market gains. At the time, our earned dividends was in the $2,000, $3,000, probably in the $3,000. No, it was in the $2,000 range. At the beginning of the year, we have broke over $3,000 this year in earned dividends, and we're chugging towards breaking $4,000 in earned dividends. This number will never go lower because those earned dividends are now in our portfolio, will never be removed from our portfolio, and have acquired up more shares, whereas the market gain within the portfolio, that's going to fluctuate on a daily, weekly, monthly, yearly basis, regardless of, into the future. So that position, it may go low, it may go high, but these earned dividends are going to continue to roll in on a weekly basis and just continuously pay us dividends. Now, our best performers here, they remain the same. I believe last week, Avi and Main Street Capital had been in 2nd and 3rd place, and Apple has remained number 1 for quite a while. That one's going to be the top contender for quite a while. As far as our worst positions, we do have a new position in the red, which is Colgate. This one did dip down into the negative by 1.39%. IIPR, while it does appear to be down, 49.4%, it did make a bit of a pop within the last week. Digital Realty Trust looks to be moving towards the downside. I did make a video last week. I went ahead and covered our worst positions out here, why I'm not invested in them. None of them really have any recent earnings to kind of showcase why they would pop up to any, to the upside for any reason. Right now, there's just no end in sight for their decline. There may be some little portions where, hey, there's a potential for they tick upwards and they might form some sort of support and bottoming out. But as of now, there's no reason to invest at this moment. So I'm just kind of letting them drip out to the negative and then focusing my capital towards positions that are better fit for the long-term investing. So those are our overall performance. Now jumping into the weekly performance. Now we had a bit of a decline here in the market. So not only did we break and fall below the 50, or I think it was the 50-day moving average, we continue to build up momentum on the way down. and we are down 3.4% on the week. You can see here that that tallied up to about $1,500 of total market gains lost in a week. This isn't bad overall. I've seen very big portfolios. I mean, my other portfolio is a bit bigger than this, and it was it was pretty brutal watching it on a daily basis, losing equity in there in these positions. So if you're not used to seeing all that red, or you know, generally you see a lot of green, and that's really, it's a euphoric thing. It makes people feel like they did a really good job picking out their stocks. But hey, when stuff turns to the downside, it's gonna happen. You got to be ready and prepared, and all that fun stuff. So our best three performers this week, hey, guess what? Starbucks up 2.95% this week. Avi up 1.87, and Merck up 1.23. Johnson & Johnson as well, positive 1.14. So what I see here is healthcare. We have pharmaceutical, Avi, Merck, and then we have Johnson within the healthcare. So just by looking at my positions here, I think that healthcare is going to be one of those stronger sectors, maybe coming back as a solid investment. Starbucks, it had been beat up so much in the last few months that it did find a bit of a bottom, had regained a good chunk afterwards, and seems to be building some momentum to the upside. So that is really good for Starbucks. Every other position was a negative in the portfolio, with ABM Industries being our worst performer, Avery Dennison being in second place, and Digital Realty Trust, this is that second place loser in the portfolio, down 9.07. So yeah, a bit of a hard hit within those positions. So that is the weekly. Now, how did our portfolio do in comparison to, say, the S&P 500? Now, here's the S&P 500. It put up a nice 1% gain on Monday. It opened high, retained that 1% gain throughout the day. As of the morning, it had already opened positive after Friday's big loss. I think Friday was a big loss, but it did retain that. Open Monday down huge. I think it was down 3% on open, continuing to decline another 1.5% nearly over the remainder of the day. Wednesday didn't quite make any sort of recovery. Thursday, Friday just continued to bleed out into the week, down 4.77%. This is putting us very close to being down 20-some% year to date. I think our year to date, as far as negativity goes, I think it was around 28%, like right around. I don't think we dropped 30%, but I know we were in the 20% to the downside here. So this is getting back, and we may retest these lows. There's no reason not to. Johnson & Johnson down 4.13. The Nasdaq here down 5.48. So this is what we're talking about. Our portfolios within the last week, anywhere from 3 to 6%, right? Dow Jones and the Nasdaq here got hit pretty hard. The Russell here down 4.5%. So yeah, a lot of negativity out there in the market. So our portfolio overall, did fairly decent. I'm not going to say it did well, but it did decent. It had a couple positions in there, healthcare, that really helped out the portfolio. Now, if we take a look at the 1 week performance and we take a look at S&P 500, yeah, the healthcare sector here does stand out. J&J, Avi, Bristol Myers, Gilead Sciences, Merck, they were all pretty positive. We can also just kind of hover around here, and you can see a few others were in the green here as well. And yeah, so healthcare looks to have kind of held up a bit, but just about every other sector out there was negative. One thing to kind of look at is Netflix. Netflix had already dropped, I think they were $600 at some point at the beginning of the year, and now they're up 2.81% on the week. So looking at Netflix, they might be forming some sort of a bottom. Tesla is up 1.23%. Wow, that's $303. Wow. I haven't watched Tesla in quite a while. They had traded at over $1,000. They dropped to $600 for a while, and a lot of investors were pouring capital into it at $600. It's been a while since I've looked at it. It's $303. So that is pretty mind-boggling right there. So that is the weekly performance. Not any one really safe area. Even healthcare got hit a tiny bit here, but if you have some of those solid ones like J&J, Avi, Merck, you've kind of came away okay, but the rest of your portfolio essentially beat you up. So that is the 1 week performance. Number 3, we did make some buys last week. Looking back, hey, we may have been able to wait it out a bit, but that's okay. We did make 2 buys. We purchased Lowe's 225 and Pfizer 225. We also took profits on Lockheed Martin of $300. So we took profits on Lockheed Martin, and we moved some of those profits and equity that we had in the portfolio over into Lowe's and Pfizer. And then throughout the week, we had Main Street Capital paying out 16 cents in dividends. We had Realty Income paying out $6.80, and Main Street Capital paying out $8.39. Main Street, Realty Income are all monthly paying, almost REITs. Main Street's a BDC, so these pay every month on roughly the mid-month. They pay out together, and together I made $15 and some change. Looks like maybe $16 and some change there. I don't want to add them up at the moment, just want to keep chugging along. But between that equity and then we added a bit more, we have total buying power of 143.02. I don't have anything in mind at the moment, and where we will go within the market, I don't actually know right now. We're looking at the S&P 500, and then I'm looking at the 200-day, 50-day moving average. We did hit a point not too long ago. We were at the 50-day moving average, and I was saying, hey, I posted on my tab right here. I went to the community tab, and I posted, hey, SPY, what will it do? Here we had this this move here, where back in May, it had a lower double bottom. It had a bit of an increase there, just a short increase, and then it just dropped below, where it had already kind of bottomed out. Then once again, it had another little double bottom right here. And what this one did is, again, hey, it moved to the upside, showing some signs of recovery. We did hit a peak of around $429 at this point. We bounced off that 200-day moving average, and here we are moving back down. We actually hit the 200-day or the 50-day moving average right here on September 15th. We hit the 50-day moving average. Now at this point, we can go in any direction. We could have moved higher, and that 50-day could have moved as support, or we could have moved lower, and now we broke through that support level and moving into where now 50-day moving average is acting as resistance, and now we can retest these lows here back in June time frame here. So really the portion here, we may fall back down into, say, the 380s, 390s pretty easily from here. There's no end at the moment. So I'm kind of holding off at the moment as far as what I'm buying. Just kind of waiting. Now, jumping over into the dividend tracker, we do have all of our portfolios tracked over on trackyourdividends.com. We can see here that our portfolio is yielding 3%. Our yield on cost is 3.21. Our annual income is $1,269. So this is just based off last week's initially. This doesn't include the 2 purchases that we made within Lowe's and Pfizer, and then we sold out of Lockheed Martin. So I'm going to go ahead and take a look here at Lowe's and update all this information here really quickly. So I'm going to go ahead and pull up my spreadsheet on my other screen here and punch in Lowe's here. So Lowe's, we now own 11.04143 shares at a cost basis of $180.93 right here. We also bought into, we sold out of Lockheed Martin. So right here, Lockheed Martin, we dropped our shares down to 4.44. 4.44898, and our cost basis is now $338.91. And then I can't think of the other one that I bought. Lowe's and Pfizer. Okay, I thought it had been Pfizer, but it's always best if you don't if you're trying to second guess yourself, just recheck it. So Pfizer here was our second buy. We now own 36.51162 shares at a cost basis of $38.76. So got all that information there, so we can go over here and head down to, say, Pfizer. We can go ahead and bump in. So right now, Pfizer pays us $50.90 per year. This is every year Pfizer was paying us $50.90, basically $51, right? Our Pfizer went from 31 shares to now 36.51162. Our cost per share did increase from 37 to 38.76. So it did increase there slightly. So watch right here, 50.90. It now went to 58.42. So nice little increase right there. Also Lowe's, let's go up to Lowe's. We did buy a little bit more Lowe's. We went from 9.9 shares to now 11.04143 shares. Our cost basis went up once again from 177 to 180.93. And the dividend here went from $41.82 to now $46.37. And then, of course, we do have to remove Lockheed Martin because we did take a bit of profits on Lockheed Martin. So in this case, we are going to be lowering our shares here from 5.16 to 4.44898. And our cost basis went from 342.55 to now 338.91. So our cost basis there did decrease. So that's a pretty nice little thing right there. So our annual income is now $1,273. Our portfolio yield and our yield on cost remains the same. When I'm doing my editing, I'll post it down on the bottom of what the difference there was. But overall, that's a good little change there. I was really hoping to break $1,500 of our annual income. And we do still have quite a bit of equity to invest. So if we go to our funding tab, we can see that we're almost 100% funded for the year. There is a little bit about $1,800 remaining for the end of the year, and with the decline here going towards the end of 2022, this, if the market does continue to decline while we're averaging into the market, that will be better off for the future, right? Because then we're buying companies that are just a little bit lower versus where they had been at the beginning of the year. So that gives you a higher yield on cost. You're able to acquire more shares for the long term.